Most budgets fail because they're too complicated. You don't need spreadsheets with 30 categories to take control of your money. Instead, start simple. First, track your spending for 1 month. Write down everything. Yes, even the coffee runs and late-night takeout. This shows you exactly where your money is going. Second, set 3 main spending buckets: needs, wants, and savings. For most people, a 50-30-20 split works well. That's 50% for needs, 30% for wants, 20% for savings or debt. Third, automate your savings. Have the money move to a separate account the moment you get paid. If you don't see it, you won't spend it. Fourth, review your budget weekly. Catch overspending early, before it snowballs. Fifth, reward yourself for sticking to it. A budget is not a punishment. It's a tool to build freedom. When you keep it simple and stay consistent, you'll not only stick to your budget, you'll actually enjoy it. Smart money moves start here. Buy now, pay later services sound harmless. For small payments instead of one big bill, what's the harm? The truth is, they can be a debt trap in disguise. First, BNPL encourages impulse spending. When you don't feel the full cost up front, you're more likely to overspend. Second, missing a payment can hit you with late fees and hurt your credit. Yes, some services now report to credit bureaus. Third, juggling multiple BNPL purchases can snowball into unmanageable bills. A coffee maker here, new shoes there, and suddenly you owe hundreds. BNPL can be useful, but only if you treat it like debt. Use it for planned purchases you can afford in full, and never for ones you can't pay for. If you're already juggling BNPL payments, pause new spending and pay them off first. Remember, debt marketed as easy is still debt. The smartest by now is often to wait until later. Smart money moves start here. Your credit score can open or close financial doors. In just 90 days, you can give it a noticeable boost. First, check your credit report for errors. Even small mistakes can drag your score down. Dispute anything that's wrong. Second, pay every bill on time. Payment history is the biggest factor in your score. Even one late payment hurts. Third, reduce your credit card balances. Aim to keep your usage under 30% of your limit. Lower is even better. Fourth, avoid opening new credit accounts unless you truly need them. Each application can temporarily lower your score. Fifth, become an authorized user on someone else's well-managed account. This can give your score a quick lift. Small, consistent actions over just 3 months can make lenders see you in a whole new light. Your credit is your reputation. Protect it, and it will protect you. Inflation makes your money worth less over time, but you can fight back. First, lock in fixed rates on loans. If you have variable interest, rising rates will cost you more. Switch to fixed while you can. Second, buy in bulk for items you use often. Prices today are likely cheaper than they'll be in 6 months. Third, focus spending on items that hold value. Cheap products that break easily will cost you more in the long run. Fourth, cut recurring costs you don't use. Unused subscriptions and memberships are silent budget killers. Fifth, grow your income. Inflation is easier to beat when your earnings rise with it. Inflation may be out of your control, but your strategy isn't. Small changes today can protect your wallet tomorrow. Most people don't overspend because they're bad with money. They overspend because of how the brain works. First, the dopamine effect. When you buy something new, your brain releases a feel-good chemical. It's addictive and temporary. Second, lifestyle creep. When your income rises, your spending quietly rises too. Suddenly, what used to feel like a luxury becomes the new normal. Third, the scarcity trap. Sales and limited time offers make you feel you'll miss out, so you spend before thinking. Fourth, emotional spending. Stress, boredom, even celebration can push you to buy things you don't need. Fifth, social comparison. Seeing friends or influencers with new things can trick you into thinking you need them too. The key isn't just willpower, it's awareness. When you recognize these triggers, you can pause, question the purchase, and keep your money where it belongs. With you, not all side hustles are worth your time. But in 2025, some can genuinely change your income. First, remote freelance work. If you can write, design, edit, video, or code, platforms like Upwork and Fiverr can connect you to clients worldwide. Second, online tutoring, with AI tools handling basics. Human tutors are in demand for personalized learning. Third, delivery and gig driving. Apps like DoorDash or Uber aren't new, but using them strategically during peak hours can double earnings. Fourth, digital products and PLR content, ebooks, online courses, design templates, and even pre-made PLR materials you can rebrand and resell. Earn money long after you've created or acquired them. Fifth, niche content creation. If you focus on a specific topic and build trust, brands will pay for sponsorships and partnerships. The key isn't chasing trends, it's choosing one or two hustles. You can commit to 4 months so your skills and your income grow. Compound interest is often called the eighth wonder of the world. And for good reason. It's the secret to building wealth without constantly working harder. Here's how it works. Instead of earning interest only on your initial investment, you earn interest on both your original money and the interest you've already earned. Over time, this creates a snowball effect. Let's break it down. Say you invest $1,000 at a 10% annual return. After 1 year, you have $1,100. The next year, you earn 10% on $1,100, giving you $1,210. It might not seem huge at first, but over decades, the growth becomes staggering. This is why starting early is critical. Time is the biggest multiplier of compound interest. Even small amounts invested regularly can grow into something life-changing. But here's the key. You must reinvest your earnings instead of cashing them out. The longer your money works for you, the faster it grows. Albert Einstein allegedly said, "He who understands it, earns it. He who doesn't, pays it." Whether you're saving for retirement, building an emergency fund, or investing for freedom, compound interest is your most powerful ally. Start now, stay consistent, and let time do the heavy lifting. Investing can grow your wealth, but only if you avoid the traps that wipe out beginners. Mistake number 1, chasing hot tips. If you hear about an amazing stock from a friend, it's usually already too late. By the time it reaches you, the big gains are gone, and the risk is high. Mistake number 2, putting all your money in one stock. Even safe companies can crash. Spread your investments across different sectors. Mistake number 3, ignoring fees. High fee funds eat into your returns every single year. A 1% annual fee might not sound like much, but over 30 years, it can cost you tens of thousands. Mistake number 4, timing the market. Nobody, not even the pros, consistently guesses the perfect days to buy or sell. Instead, invest regularly, no matter the headlines. Mistake number 5, panic selling. Markets go up and down. Selling when prices drop locks in your losses. Avoid these mistakes, and your investments can grow steadily over time. Consistency beats luck every single time. Diversification is more than just owning a few different stocks. It's about balancing risk. So one bad investment doesn't sink your entire portfolio. Step 1, spread across asset classes. That means not just stocks, but also bonds, real estate, and maybe commodities. Step 2, diversify within each class. In stocks, hold a mix of sectors, like tech, healthcare, and energy. In bonds, balance short-term and long-term maturities. Step 3, go global. Don't limit yourself to one country's economy. International stocks and emerging markets can offer growth opportunities you can't get at home. Step 4, rebalance regularly. Over time, some investments will grow faster than others. Rebalancing keeps your portfolio aligned with your original risk level. Step 5, stay consistent. Diversification works best when you give it time. No single year will be perfect, but over decades, the balance pays off. A well-diversified portfolio is like a sturdy ship, built to handle rough seas and keep moving forward. FIRE, financial independence, retire early, isn't just about quitting your job young. It's about buying freedom with intentional money choices. Step 1, know your number. Figure out the annual amount you want to live on. Multiply it by 25. That's your target nest egg. Step 2, cut expenses ruthlessly. Every dollar you save now brings retirement closer. Track your spending, question every purchase. Step 3, increase your income. That could mean side hustles, freelancing, investing, or starting a business. The bigger your gap between earnings and spending, the faster you reach FIRE. Step 4, invest aggressively, but wisely. Index funds, real estate, and dividend stocks can all grow wealth. Reinvest profits to accelerate compounding. Step 5, avoid lifestyle creep. When you earn more, resist the urge to spend more. Keep living like you're still building. Step 6, plan your post-retirement life. FIRE isn't about doing nothing. It's about having the time to do what matters most. Retiring early isn't easy, but for those willing to commit, FIRE can turn decades of work into a few short years.